We'll discuss the best 5 dividend growth stocks for 2023 in this video. Let's get going. Okay, so the year 2023 has been relatively quiet in comparison to the previous few. The S&P 500 is up somewhat year to date. But there have also been some ups and downs, and those downs are particularly pleasant. Price and yield have a negative relationship. Lower prices, when all else is equal, lead to higher yields. As a result, financial independence will be easier and sooner to achieve, because more dividend income can be earned for every dollar invested. I constantly see long-term opportunities in short-term instability. I was below broke at 29 years old, but because to that perspective, I'm now financially independent at 35. Having said that, there is a large market, and some concepts are superior to others. This video is all about focusing on the best long-term ideas right now. Air Products and Chemicals, APD, is the first dividend growth investment I recommend for 2023. A significant international manufacturer and supplier of industrial gases is Air Products and Chemicals. Commercial gases. Not exactly a wonderful spot to make money, do you think? However, it is. That's because industrial gases are essential components in the production of a wide range of finished goods. And manufacturers frequently need regular, dependable access to a variety of gases. Low-cost input is essential since it basically guarantees ongoing business. But hold on. And there's more. As there are only a handful of significant global suppliers of industrial gases, this business operates within the advantageous parameters of a global oligopoly. Air Products and Chemicals has compounded its sales at an annual rate of 2.5%. And its EPS at an annual rate of 9% during the past 10 years, in large part due to this favorable placement. It's a major factor in why this stock is a renowned dividend aristocrat as well. With 41 straight years of dividend growth, Air Products and Chemicals is indeed a dividend aristocrat. 9.8% on a 10-year DGR is certainly extremely great. Even better, you get to combine the 2.4% initial yield of the company with the high single-digit dividend growth. That yield and growth combination is excellent. Based on midpoint adjusted EPS guidance for FY 2023, the payout ratio of 61.7% also demonstrates a solid dividend. This top-notch dividend growth company, in my opinion, is materially undervalued. We have already completed a thorough investigation and value of the company. The video for that should go live very soon, if it hasn't already. You can watch the video to see the rationale behind the estimated intrinsic value of around $350 per share. Currently, this stock is going for around $290. Thus, it appears to be currently undervalued by 17%. You are virtually certainly going to perform extremely well in the long run if you can get shares in this type of company for close to 20% less than they are presumably worth. Now would be a great time to think about buying stock in Air Products and Chemicals if you don't already. Broadridge Financial Solutions, BR, is the second dividend growth company I recommend for 2023. An international fintech company is Broadridge. Despite the fact that they are virtually likely familiar with this company's services, many investors might not be particularly familiar with its name. Why could they be so well known? Well, the processing and distribution of proxy materials to investors who hold positions in equity securities and mutual funds makes up the majority of the company's largest segment, and this is a service that Broadridge dominates. Those messages you receive as a shareholder? Most likely, Broadridge took care of them for you. The company's prized Proxy Edge platform, used by Broadridge, recently processed more than 80% of domestic shares that were outstanding. Due to this dominance, there has been great growth over the past 10 years, with a CAGR of 10.1% for revenue and 11.6% for EPS. Take a look at this dividend growth if you think that's impressive. 14.9% is the 10-year DGR. The most recent dividend increase was 13.3%. Therefore, there are also no significant signs of a decline in this area. With that level of compounding, the dividend doubles about every 5 years. It's amazing. Since its first spin-off in 2007, Broadridge has grown its dividend every single year. This is a reliable compounding machine, which is hard to come by in this day and age. The payout ratio has now risen a little bit. I anticipate that future dividend growth will roughly match EPS growth at 64.6%, which is not a bad expectation in and of itself. Furthermore, the 2% yield isn't particularly high, but you have to give that up in order to access compounding power. No, this stock is not a bargain. It isn't very affordable. However, the valuation is more fair than it typically is. The current P/E ratio for the stock is 32. That is clearly too high. No. Actually, no. Even higher, 33.2, is its own 5-year average. Since years, Broadridge has been resisting gravity. Why? Years ago, the market detected the market domination, substantial capital returns, and tremendous growth potential. Because the underlying businesses aren't doing well, so-called cheap stocks struggle, but Broadridge keeps putting up strong numbers. The video on our most recent analysis and valuation of Broadridge ought to be available soon. Nearly $175 per share was determined to be the fair value estimate. Currently, the stock is trading for about $144. Once more, not a deal. However, this is a fantastic business. And the price is lower than usual. Look at this. Crown Castle, CCI, is the third dividend growth company I recommend for 2023. An infrastructure real estate investment trust is Crown Castle. This is a tower, small cell, and fiber REIT with US headquarters. The station has recently shown a lot of coverage of American Tower. Crown Castle resembles a scaled-down, homegrown version of American Tower. The ability of this business model to leverage income versus fixed costs is fantastic. It all boils down to how easily the real estate can be leveraged. After a tower is constructed, there are many scalability options for adding more tenants. The returns on investment per tower are significantly higher when adding tenants, machinery, and upgrades because the expense of doing so is kept to a minimum. As a result, Crown Castle has experienced very respectable growth over the past 10 years, with revenue increasing by 10.3% CAGR and AFFO share increasing by 6.3% CAGR. Although respectable, the dividend growth is nothing compared to the yield. 9 years in a row, Crown Castle has boosted its dividend. Even though we can see the surplus there in comparison to underlying profit growth, the 5-year DGR is 8.9%. As a result, the slowdown is not unexpected. The most recent dividend increase was 6.5%, which is about in line with expectations. That's great. But what's really unique is the yield. The stock's 5% yield, which is 170 basis points greater than its own 5-year average yield, is high both in absolute and relative terms. The payout ratio is 82% according to the AFFO share forecast for this fiscal year. Unusual for a REIT, but not out of the ordinary. The price of this stock is the lowest I've ever seen. I've never seen Crown Castle priced this low, outside of complete market crashes. The P/CF ratio of 18.7 is well below the 23.55-year average. The forward price to adjusted funds from operations ratio is 16.5 based on the aforementioned expectation. That demonstrates how low we've fallen with Crown Castle, and is comparable to the P/E ratio on a typical stock. This REIT has a history of being rapidly expanding and having a high valuation. Consolidation in the telecom industry has recently been a hindrance to growth. Moreover, interest rates have increased. Sure. But compared to its 52-week high, the stock has decreased by almost 40%. The present might be the ideal time to visit Crown Castle if you've ever wanted to. Robert Half International, RHI, is the fourth dividend growth company I recommend for 2023. A multinational staffing and consultancy firm is Robert Half. Over the past 10 years, some of my best investments have been in businesses that operate largely unnoticed. Contrarily, many of the businesses that consistently make headlines do so for the wrong reasons, namely because they deliver subpar performance. As of right now, Robert Half is undoubtedly flying under the radar. And that has a lot to do with the company's strategy of offering advisory services and talent. I hear you yawn. Well, this business model is a successful, high-margin way to generate a lot of revenue. In fact, during the past 10 years, Robert Half's revenue has increased at a compound annual rate of 6.2%, while its EPS has increased at a pace of 14.2%. Here, the dividend metrics are excellent. With a 10-year DGR of 11.1%, Robert Half has increased its dividend for 20 years running. A low yield is typically present along with a double-digit dividend growth rate. Not in this instance though. The stock has a 2.6% yield. That easily surpasses the competition. Its own 5-year average is 70 basis points higher than this one. Need more? Okay. There is just a 31.8% payout ratio. Great dividend metrics, as I had mentioned. There is nothing I can criticize. This unassuming moniker, in my opinion, is critically underestimated. Given that Robert Half's stock is currently 35% below its 52-week high, the company should almost be renamed, Cut in Half. But what this has accomplished is that it seems to have produced a very favorable valuation. If it hasn't already, we'll have a comprehensive analysis and valuation video on Robert Half that will go over the entire company and explain why the estimate for fair value comes out to be little less than $100 per share. Currently, the stock is trading for about $73. Huge potential for growth. There is no long-term debt reported on this company's balance sheet. Additionally, in February, management unveiled a sizable buyback program. Right now, purchasing the stock in addition to the business itself would not be a terrible move at all. Toronto Dominion, TD, is the fifth dividend growth stock I recommend for 2023. An international banking and financial services company with its headquarters in Canada is called Toronto Dominion. I had to include at least one bank in today's list, after all. Following a few ephemeral bank failures that were more indicative of local mismanagement than general banking problems, banks have been severely hit over the past few weeks. Long-term opportunities can be found in the fact that banks of all sizes were sucked into the misdirected frenzy. Particularly speaking, TD is one of the biggest banks in Canada. And what a terrific position to be in, given that Canada essentially has a banking oligopoly going on, with 5 huge banks controlling a monopoly-like amount of the market. Because of this, TD posted a 6.7% CAGR for revenue and an 11.8% CAGR for EPS over the last 10 years, despite the fact that this was a tremendously difficult decade for banks. The dividend history of TD is impressive. TD has boosted its dividend for 9 years running. This insufficient track record does not adequately reflect the bank's extensive dividend history. Although TD's current structure was created through a number of mergers, which cloud matters, we can trace a consistent dividend payment for more than 160 years. A strong DGR for the past 5 years is 8.7%. But the fact that this growth rate is coupled with the stock's market beating 4.6% yield makes it all the more compelling. Wonderful mix. And I have no doubts about the dividend's sustainability given its payout ratio of 46.4%. I see the unfair penalty meted out to this stock as an opportunity for opportunism. TD was not involved in any of the bank failures that took place. However, the stock quickly fell by about 20%. In a matter of weeks, we moved from a valuation that seemed about fair to one that seemed quite attractive. In an upcoming analysis and valuation film on TD, which will present the argument for the bank's value of $75.24 per share, the main content has already been assembled. Back in February, it was almost there, but the stock is currently trading at about $61. This might be the ideal buy the dip opportunity, if there ever was one.